In this small video, we're going to look at the Australian bond market and some of the conventions and do a couple of quick examples. In general, Australian bonds typically pay 2 coupons per year, and in problems and examples, assume this unless told otherwise, because that's generally the convention in Australia. The face value is paid at maturity. Coupon rates are quoted as an annual nominal rate of return, with semi-annual compounding, obviously, because they pay 2 coupons per year, so they're paid semi-annually. The yield is market determined. Convention is that the yield to maturity, YTM, is often an abbreviation, or just simply the yield, is used to price the bonds. And the market convention also assumes semi-annual compounding, sometimes called the return on the debt. To get that, we just simply divide the yield to maturity by 2 to get our discount rate by convention in the market. One of the most popular debt instruments in Australia is a 90-day bank bill, and serves as a reference rate for many loans in the market. So often you'll see companies with loans, and they have to pay a margin above whatever the 90-day bank bill rate is. So you might have to pay, say, 2% above. Most 90-day bank bills are issued by banks in Australia and some very large corporates. The face value is usually $100,000. Again, this is generally the convention, and you can assume this unless otherwise told. Obviously, why they're called 90-day bank bills, because they have a life or a maturity of 90 days. How are they used? Well, sellers, they're the people who issue the 90-day bank bills. They obviously want to raise money. They've got short-term needs for money. They may need working capital. They might just have some short-term financing needs, and they know that they're going to get a large payment from a customer in 90 days or 180 days. So they issue some 90-day bank bills to cover the gap until they get the other money in. On the other side, you have buyers, and they want to invest money. So here they may have received a large amount of money from a customer and they don't need to spend it yet, but they are going to need the money, so they don't want to pay it out to shareholders. So in this case, they might want to invest that money for a short period of time, and so the buyers will invest any excess cash they have. Since 90-day bank bills have such a short maturity, the market convention does not tend to bother with compound interest. Rather, to work out the price of a bond, you simply take the face value of the bond, divide it by 1 plus whatever the yield is, and you multiply that yield by 90 days divided by 365 days to work out what the price is. Again, because they're so short, there's no coupon payments, so simply you get the face value at the end of the 90 days. So in this example, we've got $100,000 face value. The yield in the marketplace is 6%. We obviously have a 90-day period. There's 365 days in the year. So the price of the 90-day bank bill would be $98,542.12. In Australia, let's have a look at valuing a bond. So let's look at an example. In 2003, we have a $10,000 bond. It's due in 2018, so it's got a 15-year maturity with 10% coupon with semi-annual payments. It's a convention in the bond market that interest rates are expressed as simple interest or nominal rates rather than effective annual rates. So the coupon rate of 10% per year with semi-annual payments implies coupons equal to 5% every 6 months. So in this case, So in this case, if we're getting 5% on a $10,000 bond, we're going to receive $500 every 6 months. We discount these payments at the investor's required rate of return. So let's say the risk-free rate is 5% and our investors require a default risk premium of 3%, then the required yield or the cost of debt will be 8%. Also note, this is normally quoted as a nominal rate. So that would be 4% each 6 month period. Note, we would expect the bond to be priced at a premium because we can see that the yield, 8%, is less than the 10% coupon. So let's work this out. So each coupon, as I said, 5% multiplied by the face value, $10,500. Bond matures in 15 years, so that means there's 30 payments remaining for the coupons. The present value of the interest payments is basically an annuity for 30 periods with a cost of debt of 4%. How do we get that? Well, the risk-free rate is 5%. We have a default risk premium of 3, so the total cost of the debt will be 8. That's on a per annum basis. We pay the coupon semi-annually, so we need to divide that 8% by 2, so we get 4% for each 6 month period. So we then work out the annuity formula with a 4% interest rate, 30 periods, coupon payment of $500 in each period, and we find that that's worth in total $8,646.02. We then also find the value of the face value, we find the present value of the principal or the face value. So we take the 10,000, divide that by 1.04 to the power of 30 because there's 30 periods. That's worth $3,083.19. So the total value of the bond is $11,729.20. And again, as we expected, the value of that bond is trading at a premium to the par value. So just as we said before, we expect the bond to be priced at a premium because the yield is less than the coupon rate. So we can also approximate what the yield to maturity is. So the way that we can do that is we can work out an approximate yield to maturity. So we look at what's the income per year and what is the capital or gain or loss per year, and divide that by the average investment base. So we look at the coupon payment we get each year, and then we add the par value minus whatever the price is, divide by the terms of maturity. You divide all of that by the price plus the par value, divide by 2. So let's say in 1 year the bond price has fallen to 10,500. So in this case we can work out exactly what the yield to maturity is by using the formula. So we know the price is 10,500, we know the coupon's 500, we know that in 1 year's time there will only be 28 periods remaining. So our time period is 28, and the face value of the bond is still going to be 10,000. So if we solve for the yield to maturity, we find that that yield to maturity is 4.676 per period. So that's a 6 month period. If we multiply that by 2, we get a 9.35% yield for the year. And thus, if we also substitute that number into the right hand side, we find that yes indeed we do get the price of the bond as 10,500. So we see that in this case yields have risen, and so that could have occurred for one of two reasons. The cost of risk-free debt has gone up, and consequently so has the cost for all bonds. Or it could simply be that investors think that this company may be, or the debt on this company may be a little bit riskier, and they've increased the default risk premium, and so therefore the cost of the debt has gone up. Now, alternatively, we could have approximated what that yield to maturity is rather than solving explicitly for the cost of debt. And we can do that using the approximate yield to maturity formula. So here the coupon payment would have been 500. The par value was obviously 10,000. The current price is 10,500. So we deduct that from the par value. Divide by the term to maturity. So there's 28 periods left. In this case, the price is 10,500. Add the par value 10,000. Divide that by 2. And here we find that we get an approximate yield to maturity of 4.7%. So again, that is quite close to the 4.676, which we actually got by solving the equation. So we get pretty close to what the actual yield is using this approximate yield to maturity. The last thing that I just want to cover in this video is that the yield to call may be less than the yield to maturity. So remember we said that some bonds, the issuer has an option to call the bonds in. And so this reflects the return to the investor if the bond is called and isn't held to maturity. To estimate the yield to call, we just apply the same method as discussed, but assume that the bond is called at the first opportunity. So instead of receiving the par value at maturity, the investor receives the call price at the exercise date. We're not going to look at bonds with call features, particularly in this course, but just so that you're aware of bonds with call options. And that's all we're covering in this short video. We'll be back for some more details on debt and credit. Thank you.